This video's performance element is financial analysis. So we're going to start by talking about the fundamental principles of money. The first performance indicator is to explain forms of financial exchange. So credit is the first type, and it enables a business or individual to purchase goods and services in exchange for their promise to pay later. It is most helpful when consumers want to make major purchases, though it is often used for more common, less expensive items. Customers are typically issued a credit card from a bank to make such purchases. Debit is a variation of credit. Consumers using a debit card authorize a seller to withdraw funds directly from the consumer's bank account at the time of sale. A cash sale is any transaction in which the customer pays for the item with cash or a check. Other forms of retail sales transactions include layaway, on approval, and cash on delivery. Layaway means removing merchandise from stock and keeping it in a separate storage until the customer pays. In an on-approval sale, an agreement is made permitting a customer to take merchandise home for further consideration before paying. And a COD, or cash-on-delivery sale, is a transaction that occurs when a customer pays for goods at the time they're delivered. Identify types of currency. So, currency is used in cash sales, which are transactions in which the customer pays with cash or check. And a check is a written document that authorizes the transfer of money to be drawn from a bank account to a person or business. Credit enables a business or individual to purchase goods and services in exchange for a promise to pay later. It is most helpful when consumers want to make major purchases. Customers are typically issued a credit card from a bank to make such purchases. Debit is a variation of credit, as you know, and consumers using a debit card can authorize a seller to withdraw funds directly from their bank account. Describe functions of money. Functions of money include functioning as a vehicle to pay for purchases, save for the future, and build wealth. Individuals and businesses pay for a number of purchases using cash, credit, checks, and debit forms of payment. In addition to personal and business purchases, money is used to pay for government services through taxes. As a savings instrument, money may be set aside in a variety of ways in order to have security for the future or to have on hand later for a large purchase. Money can be used as an investment tool as well. Stocks, bonds, mutual funds, and retirement accounts, which we will talk about later, are ways that money can be invested in order to build wealth. Other types of investment vehicles include real estate, precious metals, and collectibles. Describe sources of income. So the primary source of income is the wages or salary you earn from your employer. Other sources of income can include tips, gifts of money or property, and interest earned on a bank account or investment. You may also receive money from the government, and that's all considered income. Explain the time value of money. Time value of money is the increase of an amount of money due to interest earned over time or dividends paid. It is the idea that money invested now is worth more later because you would earn those interest or dividends on it. Interest is money you earn over time as a percentage of the principal or original amount of money on the deposit. Finding the future value of your original deposit is called compounding. With compounding, your money increases in value faster and faster over time. Figure the future value of your money by multiplying the principal by the annual interest rate and then adding the interest to the principal. You can determine this future value for as many years as your money will be on a credit account. Explain the purposes and importance of credit. Credit enables businesses or individuals to obtain products for a promise to pay later, and they can use credit to buy materials and supplies from other businesses. Credit makes it possible for millions of people and companies to purchase goods and services who don't have the direct means of doing so. By extending credit, businesses provide a purchasing incentive to customers, thus enhancing their sales revenue and supporting the overall economy. And lastly, explain legal responsibilities associated with financial exchange. Legally speaking, a sale is a contract in which ownership of goods transfers immediately from the seller to the buyer for a price. If the transfer of ownership will take place at a future date, it is called a contract to sell rather than just a sale. According to the UCC, or Uniform Commercial Code, goods are tangible, movable personal property. Payment occurs when the buyer delivers the agreed price and the seller accepts it. The receipt of goods is when the buyer takes physical possession of the goods. A court may find that a contract is unconscionable or grossly unfair to one party or another, and in that case, a contract may be voided or limited.